Okay. Good afternoon, everyone, and welcome to today's webinar, How to Find the Best Multifamily Investments for Your Self-Directed IRA, presented by Next Generation and Disrupt Equity. I am Erica Fiorito, and I am the marketing specialist here at Next Generation. So before we get into today's discussion, I would like to review a few housekeeping items, introduce our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded for anyone who didn't have a chance to make it live, and for those who wish to watch today's session again. If you're here with us live, it's great to have you. Things obviously look a little bit different than they usually do. And I announced this on the last webinar, but we're now using Zoom. So I just wanted to, obviously point that out. But with that, everyone joining today's session is going to be automatically muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So I'd like everyone to take a moment to find their Zoom webinar controls down at the bottom of your screen. And I want you to focus on two of those tabs. One of them is questions, the other one is chat. So if you have any questions during today's presentation, you can ask the questions tab. If the questions are relevant as we go through, we'll get to them. Otherwise, they're going to be held for the end. And then chat. So any other feedback, banter, whatever, can go into the chat box. And that's also where I'd like for you guys to introduce yourselves. Let us know where you're from, why you're here, and anything else that you may want to add. So for today's conversation, we have our co-host, Faris Musa, the principal at Disrupt Equity. And alongside him, we have our very own Scott Ritchie, who is Next Generation's business development representatives. We'll get to a bit more about them later on in the presentation, but for now, I'll get into a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. So these plans are much like the plans that you would find at a brokerage like Charles Schwab or Fidelity. The only difference between those two accounts or those types of accounts are the investments that can be held within them. So instead of investing in publicly traded assets like stocks and bonds, mutual funds, you can invest in alternative assets through a self-directed IRA, like real estate, which is what we're here to talk about today. So there are two main arms to our business. The first is our administrative firm, which is Next Generation Services, which is also our headquarters located in Roseland, New Jersey. Next Generation Services handles all of the back office administration, record keeping, and mandatory tax reporting, and all the transactions support for our client accounts. Next Generation Trust Company, which is located and chartered in Sioux Falls, South Dakota, is a licensed chartered trust company, which serves as custodian for all of our accounts. Accounts are named with Next Generation Trust Company as custodian and holder of the assets for the benefit of the individual account owner. And before we kind of kick things off, I have to give our very necessary disclaimer on what we don't do. So Next Generation is not a bank or fiduciary, so we do not provide any financial, legal, or tax advice. Next Generation also does not endorse, recommend, or review the merits of any investment. So any information provided on today's webinar is for educational purposes only. So to hand the floor off, we can get into some introductions. So Scott, I'll let you start off, tell us a bit about yourself, and then we'll hop over to Faris and get into today's conversation. So Scott, over to you.
Well, thank you, Erica. My name is Scott, and as Erica alluded to, I am the business development representative here at Next Generation. I've been with Next Generation for 2 years, just over 2 years, and prior to coming here, I've worked in traditional markets in IRAs. I did have a Series 6. I've also worked in public relations and media relations as well. So I'm happy to be here today, and I'm looking forward to having a very engaging conversation with Faris.
All right, Erica, Scott, thank you guys for having me. Maybe a little bit of background about myself. Managing partner at Disrupt Equity. I actually came from technology. So I used to work at Microsoft as a program manager there. And we've been able to leverage that to really help us find and execute on attractive assets for ourselves and our investors. And today, we basically are in multiple markets. We're out throughout Texas and Georgia, and we're looking at expanding into Florida as well. And we are vertically integrated. We do have our own management company and some other auxiliary businesses as well.
Thank you both. All right, Scott, let's get into it.
All right, well, thank you, Ferris. And based on what you had just said, the introduction to Disrupt Equity, why don't you tell us a little bit more in detail about your company?
Yeah, so maybe a little bit more, right? Started the company several years ago, and really, for those that probably don't know me, right? I came from Microsoft, kind of came from that tech world, had a software company, and ultimately got into real estate myself and realized there was kind of an opportunity in the market, right? To really use data and systems to kind of help us be more effective and efficient than others. And so we've been able to really use that as kind of our launching pad to kind of build up the company that we've had today. And so Disrupt Equity as a whole, what we do ultimately is we go out, we identify assets that we think that there's attractive yield for, right? We raise the money with our investors. Self-directed IRAs being a very big part of that, right? It's very kind of crucial to the business. We acquire the asset and then we operate it. And so we do have our own management company, and we kind of do the A to Z in multifamily, right? And what I like to tell people is we're cash flow investors, and ultimately, we don't force investors to hold on to the deal, right? We make exits whenever it makes sense. It's all market driven. And so, last year we had 6 deals that we sold, and we're looking to sell more this year as well.
Okay. Well, let's just start by going down the single family versus multifamily. Which is a better investment for that you see in a retirement account?
Yeah, so what I like to tell people is that there's not a wrong way to invest in real estate, right? I love real estate as a whole, and me personally, I started in the single family ish space, and the reason I say the ish is my very first purchase ever was a fourplex, which is coincidentally about a mile from our office, and then I bought a bunch of houses after that. And for me personally, I realized it just doesn't scale very well, right? And for our investors today, the single family side is not very passive, right? It's a lot more active, even if you have a property management company, right? There's a lot that's involved. The thing that I hated about it is you have, if you have 15 houses, you have 15 insurance policies, 15 loans, et cetera, et cetera, et cetera, right? It doesn't bundle very well. And so, kind of got into apartments, and it's amazing, right? It's a people, numbers, and systems type of game. And for our investors, it's extremely passive, right? And I think that's ultimately maybe the appeal for me and our investors, right? You have dedicated team, dedicated resources. Whenever you have a 200 unit property, you have 4 employees at that property full time, versus if you have 10 houses, you kind of have maybe half a person jumping around between properties. And so they're very different asset classes. Both have their pros and cons. And maybe the last thing I'll add is with multifamily or any commercial real estate is the way it's valued, right? Your house, if you buy a house, is not going to sell more than the other houses in the neighborhood, right? You can sell for a little bit more, but it's valued based on the houses in the neighborhood. And maybe not to go off on a tangent, but I know someone that basically owned 40 houses in one neighborhood, and he sold himself a house at a really high price point just to create a comp to essentially say, hey, look, houses are valued more, right? You don't have to deal with that in commercial real estate. Commercial real estate, the valuations are based on income. And so if I can do things to push the income, I've now increased the value of my asset. So, it's a very different kind of business, I'd say, than houses. And again, there's not a right or wrong, right? It's ultimately, I tell my investors, it's about what's a fit for you, right? Because some people really want to have a house that's in their neighborhood and they can go drive by it every single day. Right. Whereas for us and our investors, we invest in multiple markets, and many of our investors never even go put eyes on the asset. Right. So it's passive in its truest form.
Okay. Well, it's interesting because you had said multifamily and apartments are essentially the same. It's just this terminology is essentially the same, correct?
Yeah, exactly right. There's a lot of overlap, and then now multifamily technically by the government is anything over 4 units, right? So if you're doing agency debt and you're buying a house, well, whether you're buying a 1 unit house or a 4 unit house, it's the same debt. Once you get over 4, it's considered commercial, right? And now you're maybe more in the multifamily apartment space.
Oh, okay. That's good. That's good information. Now, how would an investor accurately review or analyze multifamily real estate offering documents to know what's a good deal and what's a bad deal?
Yeah. So first off, I tell people you are 100% investing in the operator, right? Regardless of numbers, the operator is probably the number one thing that I look for, right? And what is that person's track record? And there's nothing wrong with a new operator, but I think one of the problems in this space is there's a lot of smoke and mirrors. And really get to know your operator, get to know what they've done, what is their track record, and deals that did they actually, were they the chief of, or were they just involved in other deals, right? And I think that's the number one thing to look for. from that, I do tell investors, go get educated. There's a lot of content out there. We create a lot of content as well that we push out to get people educated on, how do you start to look at these investments, right? People don't understand cap rates. They might not understand cash on cash or IRR, right? Go get educated. To me, a good investor is an educated investor because, with these investments, right, there's a lot that happens. And, the more educated an investor is, the more they can work through the process, right? And ultimately, A, find assets that they like, and B, get return on their investments. And so, I tell people, understand, go get educated, right? And, walk through the story that the operator is saying. And then from that, work back in the numbers. And so there's a couple of key numbers to look for, right? Cash on cash, IRR, cap rates. And, you want to look at what are they modeling the selling price? Does it make sense? I think that's the number one thing that as an operator, the easiest thing I can tweak to make a bad deal look good is the exit cap rate, right? If I'm buying a deal at a 4% cap rate and I say I can sell it at a 3% cap rate in 4 years, well, guess what? Just in the difference in the cap rate, which is the whole point, I've increased the value significantly, right? And I don't want to lose people in a lot of terminology, but understand how it's being modeled and see if the story makes sense to you. If I tell you I'm going to buy a deal today at 100 a unit and I'm going to sell it tomorrow for 500 a unit, it probably doesn't make sense, right? So I think, if you're getting, your spider senses are tingling, I tell people definitely pause and talk to, understand the story, and then talk to investors for that operator. Any qualified operator has a Rolodex of investors that they can point to. And I think I tell people, go get comfortable, go understand what's going on. And maybe last but not least, it's a long-term relationship, right? These deals are typically, most of our deals, we model them 5 to 7 year plays, right? We made it last year, we sold 6 deals. All of them were 2 to 3 year holds. But again, go in with that long-term mindset and, hope for kind of more than that, but really understand the deal, understand the story, and see if it's a fit for your investment criteria.
Oh, what would be the common deal structures in a multifamily, and how would it work within a self-directed IRA?
Yeah, so, I'll answer the second question, then I'll come to the first. So what's beautiful about what we do, right? We syndicate and we raise equity from investors, right? And whether they're giving they're funding from, a bank directly where they have cash sitting, or they're funding from their self-directed IRA, there's no different to the investor, right? Ultimately, it's, from the deal perspective, it's money that came in, that investor owns a piece of the LLC, right? And maybe to kind of give people context, right? Whenever we do deals, right, the way it works is all the investors are shareholders in the LLC. The LLC is what's buying the asset, right? And so investors investing, they're getting a pro rata piece of that LLC. And with that comes rights as an investor. And I tell people, read your PPM, read the company agreement, understand all of the nuances of kind of what you're getting in terms of rights. But whether you're a person investing with cash in hand or you're investing with an IRA, no difference, right? The important thing then is to understand the deal structure, right? And deal structure, there's a couple of key terms for people to understand. First one is, does the deal have what we call a preferred return? What a preferred return is basically saying, hey, investors are going to get a fixed annual return on their investment first, right, in full, before me, a sponsor, can split the profits, right? And so typically a deal might be a 7% preferred return, meaning I ensure my investors of any profits, they're going to get 7% return on their money first, and then anything left over, we'll share that pot, right? And so you want to understand, is it a 7 pref? Is it a 6 pref? Is it a 5 pref? Is it an 8 pref? Right? That's one piece of terminology. The other thing to understand then is, what is the split after that, right? Is it, after the preferred return, is it 60-40 split? Is it a 70-30, right? And so that's the other big piece of the deal structure. And then last but not least, I tell people is understand what fees is the operator taking, right? They take an acquisition fee, a disposition fee, what's the asset management fee? There's a couple of other fees that are, that are market driven, but understand what those are. And that really, all that together makes the deal. But the biggest piece of it to understand, I think, as an investor is, are you comfortable with the fees? What's the preferred return, and what are the splits? Right. And there's not a right or wrong to that. To give you an example, if you're buying a brand new A-class deal in a fantastic area, well, that deal is going to produce less return than other deals, but it's also probably lower risk. Versus if I'm buying a property that's 100% vacant, needs a lot of money put into it, needs to get units online in a rough area, well, that's a much riskier investment, and there's a lot more work both on the sponsor and a lot more risk on the investor. So, it's about finding that balance between, as an investor, what are you looking for in the investment criteria? And then as a sponsor also, what are we looking for and how much effort do we want to put in and how much do we want to be compensated for that?
Now just quickly, because you did talk about self-directed IRAs, is it, I guess I don't need the accurate percentage, you might not know it, but what percentage or what amount of the investors are using self-directed IRAs?
Good question. Last year, last year probably raised $70 million, and of that, maybe I'd say probably 15%, maybe. I'd say on average 10 to 15% of our equity is coming from self-directed IRAs, right? And people, it's a very valuable tool. Use your self-directed IRA to invest, right? I think most people don't understand or don't know that you could use a self-direct. You can A, convert your IRA to a self-directed IRA, and then B, use that to actually invest in real estate, right? It's not about just Wall Street. I know a lot of people have that Wall Street lens, and that's what it is. But the returns that you can get on real estate are significantly more, right? With Wall Street, most people are dumping the money in an index fund, right? Returns are fairly well understood. Whereas, we've done deals where they've been, 3-digit returns, right? And what I mean by 3 digits, doubling, tripling people's money in 2-3 years, right? On the right deal. So
Now, with any investment, there's going to be red flags, especially in investments that people might not be that familiar with. What should people look out for as a limited partner? And how do you know you're going to be investing with someone who, is a competent operator?
yeah, I think the biggest thing is understand who you're investing with. Go research them, go know the people, go out to events and things like that, right? If people search disrupt equity, we have a ton of stuff out there. We are, I literally spoke at another event earlier today, right? We are a well-known entity, a trusted entity. Brokers know us, lenders know us, right? And as an investor, ask around and see, is that person first trustworthy, right? Because most people don't give $50,000, $100,000 chunks of money for anything besides a house, right? And so there's a little bit of you need to understand this person and be comfortable with them, right? First and foremost. Second from that is understand, what is the track record of that person, right? Like I mentioned earlier, there's a lot of smoke and mirrors in the business. A lot of people are good at marketing, but do they have a company behind them? Have they actually done the deals that they're mentioning, right? And so again, for us, I tell people we haven't come by the office anytime you want. Disrupt equity and management's about 130 people, and go see, is it legitimate, right? Versus, if you show up and there's one person, there's no office, right? Well, that tells you stuff. And again, there's not a right or wrong, but as an investor, it's about getting comfortable, understanding who you're investing with. Because I tell people a bad operator can make a good deal go bad, right? Whereas a good operator might be able to correct a deal that's, struggling. And so that's the biggest thing. And then, last but not least, just see, is that person available, right? I think that's one thing that I've just seen as almost like a leading indicator of a red flag, right? Is a person, can you ask them a question and they respond, or is that person just clearly not even organized enough in their world to be able to get back to investors, right? For us, and I stress this to our team, is, our asset is our investors, right? If you really think about it, we buy assets, but our asset as a company is our investors. And so treat them accordingly, take care of them, right? Be available, and other things too is performing means a lot of things. Are you getting the returns that they want? But there's other things too, right? For all of our self-directed IRAs, investors, we need to get them the valuations each year, right? Do we give it to them at the beginning of the year like we're supposed to, or do some operators, get it to them 3 months later and everybody's mad, right? There's little nuances there to really understand that are important. And so, find a firm that you like, find a deal that you like and it matches the story, and get to know both, right? And talk to their investors. That's the big thing. It's a small ecosystem. I know many of the other operators. You get to know, from their investors who's performing and who's struggling and why.
Right. It sounds like, the investor is responsible for doing their due diligence. So
Absolutely.
that's important. And, you had mentioned, talking a little bit about Wall Street, any investment, there's a risk. What would be the risks associated with this type of investment?
Yeah, it's a good question. So there's a couple of types of risk, right? There's execution risk, meaning, can the operator execute on what they're saying they're going to do, right? Like I gave you the examples earlier. If I'm buying a deep value add in a rough area, right, and I need to go put $5 million into it, and we need to get units online and get them leased, that's a lot that needs to happen. It needs to happen right. versus a deal that's already stabilized, already filled. You're just managing it loosely. Very different kinds of risk. And so you have execution risk, making sure the operator historically has the experience to do that kind of play and is capable of doing it, has the resources, right? Next up, you have market risks, which is, can you get the rents that you're projecting, right? If you're doing a value add play, can they achieve the rents that they're targeting to get, right? Is the market going to change on them? And if so, what's their, essentially exposure, right? Are they stress testing the deal? Hey, we thought, today market rents are 1,100. We thought we could upgrade the unit and get $1,400 rent, so $200 pop, but instead we got, $1,200. So we had a $100 pop. Is that, $1,300 is $100 pop. Is that okay? Right? What happens to the deal? So I think you have, the market risk. And then last but not least too, is just financial in terms of debt, understanding the type of debt that goes into a deal. I think this is maybe tied to a question that we asked earlier around red flags. Well, I think people should understand the debt that is tied to the deal, right? Because that is something that, done incorrectly can have real consequences later, right? And I'll be the first to admit, we like long-term agency debt because it's safe, but then whenever you go to sell the deal too early, you have to pay a big penalty. So, I mean, last year we sold many deals, we did extremely well, but also we paid significant dollars in penalties that had we structured the debt differently, right, we could have taken on maybe a little bit more risk, but also, paid a lot less in fees, right? So there's a little bit of a balancing act. So as an investor, you want to find a deal that matches your risk criteria, right? And as an operator, a good operator, it's always about de-risking any investment. And so we've been through the school of hard knocks on the lending side. We know what works, what doesn't. And we do things like the last deal we closed, we actually paid extra to get what's called an interest rate cap reduced. And so we paid extra to essentially say, hey, our upside risk, because it's floating debt on that deal, is capped at a certain level, which is lower than maybe what the lender wanted. And so we do things to de-risk it. And I think as an investor, you should figure out, does it all, what's the risk exposure of that debt? Does that make you comfortable or does it not match what you want?
Oh, that's great information. Let me finish up here by asking you, what would be the qualifications of your typical investor?
Yeah, so for us, most of our deals that we're doing, it's either a 506B or 506C, which means, 506B is, it has to be a pre-existing relationship with an investor before the deal, and then also they could be sophisticated. Whereas 506C means we don't have to have a pre-existing relationship, but they have to be accredited. So we've done both, and I think first thing is just get educated. I tell people, right? Everybody really fixates on sophisticated versus accredited. Yes, those are great to have, but go get educated. All that stuff will naturally figure out. And so, to me, a good investor, like I said earlier, someone that got educated, understands some aspects of the business, right? And hops in and kind of goes in with that mindset, right? And like I said, it's not a short-term deal, right? If you're looking for, I know a lot of people with self-directors love to do hard money lending. The money's out for 3 months and they get it back 3 months later, right? Well, in our business, it's a very passive, but more of a long-term play. And, as I mentioned, most deals we go in telling investors, hey, expect 5 to 7 years for the deployment, but, we'll take the exit whenever we can and take it sooner. And so I think getting educated, understanding the pieces, and, be patient.
Oh, well, listen, that's a lot of great information you gave us today, Ferret. I was just wondering, Erica, is there anybody who's attended who had any questions maybe that we could give to Ferris now, or do you want to hold off till the end?
Yeah, we have one question from the audience that I think we can address now because I think it's most relevant for Ferris.
Okay.
So the audience member wants to know, how long do you have a lockup for your investors? And for those who are joining, maybe explain that a bit and what that is.
Yeah, so I mean, a lockup means when can investors get their money back, right? And really, for us, we structure our deals typically they're a single purpose entity, right? So we all are going in with one business plan. It's not a fund; it's one asset, one business plan. And as an investor, you're in it for the life of that business plan, right? Yes, there are ways to sell your shares to somebody else, et cetera. But you have to find someone to go buy your shares first before that can happen, right? It's not the kind of thing where someone says, I need my money back today, and we can send it back to them today, right? Because typically that money's already deployed in the asset. There's not just money laying around, right? It's either deployed in the asset or we're doing return, distributions and returns to our investors.
Okay, thank you.
No problem.
Okay, well, that's all the questions that I have for Ferris. Right now, Ferris, are there any questions you'd like to know about next generation or
Yeah,
self-directed
so
IRAs?
so Scott, I think, I like to tell people that self-directed IRA is kind of the new sexy thing, right? Not enough people know about it. There's a lot of education needed, even for the self-directed IRA piece. And so I think for people, it'd probably be helpful to kind of explain, what is a self-directed IRA, right? And why would an investor use that over a typical IRA?
Oh, well, essentially a self-directed IRA is no different than any other IRA from a structural point of view. The thing that differentiates the self-directed IRA from an IRA that most people are familiar with is you have the ability to invest in alternative assets. So I explain it as the alternative asset universe. There's an opportunity to invest in things that are not Wall Street. They're not stocks, they're not bonds, they're not mutual funds, they're not ETFs. They're different kinds of investments that have been eligible for investment since the incarnation of ERISA back, I believe it was 1974 or possibly 72. But that's what, there's no real difference in terms of the format of an IRA. It just allows you to invest in alternative assets.
Okay, perfect. And so with that said, with the IRA, right, what kinds of, so you mentioned you can invest in alternative investments, right? What are some of those alternative investments, right? What does it allow you to do?
Well, we're talking about multifamily today. Obviously, that's one of them.
Mhm.
You can invest in any kind of real estate. You can multifamily, single family. You can do strategies of buy and hold, fix and flip. You mentioned hard money lending. You can loan money with your self-directed IRA. There's so many things you can do with it. You can invest in private equity. Cryptocurrency is very popular. You can invest in precious metals. Social and impacting investing is also a type of investment that you can use with a self-directed IRA. So there's really, the one things you really can't do are life insurance and collectibles. So almost anything in the landscape of outside of those two things can be used in the alternative asset universe for a self-directed IRA.
Okay, but you said the things that you can't do is life insurance, and what was the other one?
Collectibles could be
Collectibles.
oriental rugs, coins,
Gotcha.
carpets, things like that.
I'm surprised you can't do the life insurance one, but I guess there's some sort of creative loophole. That's why. Um, Got it. Well, I know one of the things that you can't do, right, is prohibited transactions. Right? And I think that comes up pretty often. And I think for people, probably be helpful to explain what a prohibited transaction is.
Yeah, absolutely. That's a great question because you're right. It's the biggest sort of taboo thing in the self-direction IRA world. Prohibited transaction is any improper transaction that's existing between an IRA and a disqualified person. A disqualified person is an IRA holder, or what we say is ascendants and descendants, children, stepchildren, parents, grandparents. A spouse is a disqualified person. Business partners, persons that provide service to the account, like a custodian or some other fiduciary. Those are all considered prohibited, disqualified people for the purpose of a prohibited transaction.
Yeah, and then ultimately the government is trying to keep, kind of arm's length, right? The whole point of an IRA is that it's locked out and away from your access, right? And so you can invest it, but you can't really take it and use it. So I make sure that you don't make that a lot easier that way. So for me, my parents cannot invest with their self-directed IRA with me because I'm obviously the operator, I'm the decision maker, and they are my parents. And so I think that's I think a lot of people, it comes up often, but I think a lot of people stress about it and don't realize it's really more about immediate kind of access, immediate relationships with those people.
Right. You know what? Ferris, I can give you a couple examples just because we look at prohibited transactions in three. There's three types. There's a per se transaction, extension of credit, and self-dealing. A per se transaction that happens when you're buying property from a disqualified person. Just a few minutes ago, I referenced what a disqualified person is. Extension of credit is when you're lending money or some other kind of extension of credit between an IRA and a disqualified person. An example of that would be personally guaranteeing a loan to the IRA. Self-dealing is when the IRA owner or other disqualified persons benefit from the IRA investment. To give you an example of that, someone earning a personal commission on an investment made by the IRA. So those things, a prohibited transaction is like I said, the thing that what we work the hardest to just to let people know you can't go there. We try to educate them as best we can on them, because what happens when you engage in a prohibited transaction is the IRA becomes distributable, meaning it loses IRA properties. So whatever's in that IRA now could become a taxable consequence to you. There could be additional penalties, and you no longer have the properties of what the IRA is. So you lose that, if it's a tax deferred vehicle, you lose that. So, we are very adamant when we're talking with people about how to avoid engaging in a prohibited transaction, because it's the biggest thing in our industry that has the biggest red flag attached to it.
All right, perfect. Okay, so then, with investing, right? And maybe I think one thing that comes up often, people, is just what timeline looks like, right? So maybe I'll start from our side, right? What that looks like. We find an opportunity, right? We confirm we're going to buy the opportunity. We start to put the deal together, and essentially we present the deal to our investors. Investors complete paper. First, investor reviews, make sure that it's a deal they want to invest in. Then it's pretty quick. They complete the paperwork and they fund, right? Then we get to closing, we buy the property, implement the business plan, and from there we start to do monthly distributions, whether it's to their bank account or to their IRA, right? And so that's the timeline on the operator side. And the investor side, what timelines do people need to understand from kind of your side of the table?
Well, that's a great question, because our timeline is a 3 to 6 weeks. Sometimes we throw 2 weeks in there. That's in a perfect world. That means everything lines up, the planets align, everything goes smoothly. Doesn't usually happen. So 3 to 6 weeks is a better way to explain it. What that entails is we take an application. Nothing can happen until the application is submitted. So we'll speak to an individual who's interested in coming on board. We'll explain the process to them. We take an application, we review the application, it gets processed. We have the account open. Once the account is open, the next step is we call our handoff process. That's where our dedicated transaction team is introduced to the applicant, now the customer, and they work with that applicant in getting the account funded. Once the account is funded, the next step is making the investment. And once the investment is made, the process is complete. It takes 3 to 6 weeks. Our transaction team does a review, a 2 to 5 day review of the investment for, make sure it meets all the criteria needed. And then we move forward. There's things in between that can disrupt that timeline. A lot of times it's where the money's coming from, the other custodian that has the money. That's out of our control. So we do build that into our 3 to 6 week timeline, but sometimes it could take a little longer than that.
Gotcha. And then I guess along that same vein, what paperwork does the investor need to give you? And similarly, what paperwork do you need from the investor, right? Or
there's always paperwork, right?
Always.
Our transaction team is great at what they do. We require an operating or subscription agreement from the investor. We want a certificate of good standing from the person that's getting the investment made to them. We also, you had mentioned a memorandum sometimes is required, and wire instructions on the application. When we know what kind of funding is going to be needed, we will have our transaction team to reach out, whether it's going to be a rollover or a transfer or a contribution. They handle that paperwork as well. So, but they're very good. They do it all the time. They're dedicated. They all work together. So once you get over to that side of the office, you're really in good hands.
All right, perfect. Oh, great. Yeah, I mean, we've had great experiences, right, with you guys in terms of, expedience. And I think as an investor, that's something that you want with an IRA, right? People that can quickly get things turned around, because these deals do move fast. And maybe I'll say one more thing right on the operator side. Signing and committing to a deal is different than getting funded, right? And so, for us, for example, whenever we raise money for a deal, typically it's a few day process, right? It moves pretty quick in terms of people completing the paperwork and committing to it. And so you want to do that quickly, get that over to your IRA, which then needs a few weeks to get it funded, which is usually the deal between launching it as an operator and closing. Usually there's a 45-day window there, which is plenty of time to kind of get it funded with your IRA.
Yeah. Well, actually, you had touched on someone, you had asked me about prohibited transactions before. I just want to kind of elaborate specifically to the multifamily. You cannot personally be an active partner or managing member when investing in multifamily real estate. The self-directed IRA can invest as a limited partner only. There's no sweat equity, or if you're familiar with sweat equity, no sweat equity on the property itself, and the investment earnings cannot be paid directly back to the IRA owner personally. So it can be taken as a distribution, but it needs to go back into the IRA. So
Absolutely. Yeah, we
I
distribute to the
just
IRA.
wanted to add that to what I was saying before I kind of missed it before, and I think it's important to note before we finalize our conversation today.
Perfect. So I know a few questions came in. Erica, did you want to maybe run through
Yes.
those?
Yeah, we have some questions. And then at the end, we'll get to some polling and wrap things up. So one of the questions that we have is, do you buy investments based on short-term income? So Ferris, I think that's probably most applicable for you.
And then I think it looks like A, B, and B. I think they're saying Airbnb. So for
Yeah.
us, we do not buy properties that are only Airbnbs, right? We do look at potentially having some Airbnb units as a way to generate new revenue, right? Or higher revenue for a given unit. So we may, we have a property that we bought in December that we're considering, hey, do we do 5 units as Airbnbs, right? Where, maybe we can generate $2,000 or $3,000 in revenue a month on those versus generating, $1,500. And that's very deal by deal and case by case.
Okay. And another relevant question for you, Ferris, do you normally refinance or sell at the end of the initial holding period of 5 to 7 years to cash out to your investors?
Yeah, so I mean, we've done both, right? It really varies by the deal. I like to tell people that ultimately my goal is to get money back to investors and they can figure out what to do with it next, right? And so we've done both. There's not a right or wrong answer. And so, personally right now, given the market environment, we're really looking at what deals are out there that are attractive, nice deals in nice areas that we can go in, do a value add component to push the revenue, do a refi for our investors to get them back their money, and then we just all hold on to the deal, right, for the next several years.
Okay, thank you. And then I think this question is relevant for the both of you, so feel free to comment, but with a self-directed IRA investment, would it be better if the asset is a longer term hold type of investment rather than an asset or business model that plans to sell in 3 to 5 years?
Yeah. So maybe Scott, I don't know if you want to answer, but I was going to just say, given that it's an IRA, I think it doesn't matter. It's really up to you as the investor, right? Do you want to do the homework of having to find another opportunity to get redeployed into, right? Because that's a little, even we have investors that say that's like, great, give me back my money, but now what am I going to go put it into, right? And so then that's whenever they come back and say, I need you to go find another deal because I need to give you back the money to go put it into another deal. And so as an investor, it's more about, do you want to do that work or not?
Yeah, I would agree. I would just say, I think it's important to know the time horizon. If they're close to retirement, if they're a 30-year-old versus if they're 58 years old, because
That's a good point too.
The time horizon when they're going to need the money would dictate how long the time frame they are using it to invest.
Okay. And to that point, there's another relevant question. What is the benefit of using an IRA over some other form of account that may carry similar tax advantages?
Yeah, so I think, sorry, repeat the question. I was reading a different question.
I think this might be more relevant for Scott, but feel free to comment. So the audience member wants to know, what is the benefit of using an IRA over another form of, they said ownership, but I think they meant account, that may carry similar tax advantages?
Well, I'm not sure other tax advantages account versus an IRA. An IRA, if it's a traditional IRA, it's going to be tax deferred till you go to distribution. So I don't know what other tax preferred account might operate from within that space. But I think the IRA is just going to, because it's a tax deferred vehicle, it's going to delay the paying of the taxes to the government until you go to distribution. So that would probably be your better vehicle. I mean, I would probably need some more information on that if they want to reference which kind of product they're talking about. But I think the IRA would be the better way to go.
Okay, thank you. Okay, let's see. First, I think this one might be for you. Any legal aspects that would not allow you to convert the entire, say, 15-unit property to STRs? And at what point does it become considered a hotel / bed and breakfast and need those specific certifications?
Yeah, so I don't know the answer to that because it really varies by market, right? Every market, every state has their own set of rules. I know there's been a lot of complaints like in markets like San Francisco and New York about short-term rentals. So it's really market driven and there's not real one size fits all answer.
Okay, thank you. Okay, so this one is probably relevant for both. So we obviously had mentioned distributions when using self-directed IRAs to invest in multifamily, and that they have to go back to the IRA and not the individual's bank account. So is that the same for SFR?
Single family rentals.
Yes.
Yeah.
It's
Scott, do you want to answer that one? The answer is yes.
Yeah.
But I think
I don't think it matters
all
what
profits
what
on your
it
IRA
is.
needs to go back to your IRA, period.
Yeah.
Yeah, that's why. Thank you, Ferris.
Not a problem. If you guys
Yeah,
are
that
hiring,
was
just let
kind
me
of
know.
a
Yeah, I was just about to say we
matter-
might have an opening for you.
No matter what, it has to go back into the IRA. So any type of real estate investment, any type of private equity investment, any type of investment, no matter what you're doing, anything that is profited from that investment needs to go back to that IRA account for later distribution once you've reached retirement age. So we had a lot of really great questions. I am surprised, actually. I think we've still got some more. So I know we still got time, so we'll keep going. Another audience member wants to know, in an LP or syndication, a large part of the cash flow can be covered by, oh, I'm sorry. This may have just been a general comment. In an LP or syndication, a large part of the cash flow can be covered by depreciation and interest if leveraged. This versus an IRA, which is actually increasing the tax liability over time. So I don't know if Ferris, maybe you want to comment on that?
So what he's trying to say, right, is ultimately with our assets and our investments in any real estate, right, you get depreciation. And what's great about commercial real estate is that we can do things like what's called cost segregation to get accelerated depreciation and bonus depreciation. And that's a lot of words that I just said, but what it really means is take the IRA piece out of it just to remove that complexity, right? An investor that puts $100,000 investment in a deal, typically year one, we're giving them a $60,000, $70,000 paper loss, even though we might have distributed, right? Because we can get so much in depreciation up front. And so what he's kind of alluding to is, with just even a standard investment, you can usually get rid of a lot of the tax liability, right? And not have to deal with that because it's offset. But now that's a little bit of a misnomer. And I tell people, go talk to your CPA, go talk to your tax professional. There's a lot to unpack in that because there is something called a catch up. And, because we sold a lot of deals, trust me, how I know from last year, right? We made, a lot of deals that we had a lot of paper losses on. Well, now we capitalized on that, right? And the government comes back and says, well, you said you lost $2 million on this asset, but you actually just made $3 million, right? And so now we have that $5 million spread. And so there's other ways to play with it and roll with it. And I tell people, go talk to your CPA to kind of really understand how do you best protect yourself and structure. Because done correctly, real estate is a vehicle that allows people to never pay taxes in their life. And once someone dies, the tax liability goes away 100% too. So it's a good way to pass down generational wealth.
Cool, thank you.
Eric, I'll just jump in.
Yeah.
When you were talking about, we've been kind of, well, I don't know actually if this next question is relevant to it, but I was going to say, we've been kind of talking about traditional IRA and the tax deferral and distribution, but you can also self-direct a Roth IRA. You could self-direct a simple IRA. So if you have the ability to use a Roth IRA, you're earning, you're growing tax-free, and you don't have to worry about the distribution rules as much as with a traditional IRA. So I just wanted to make sure that people understood you could also use a Roth IRA when investing.
Yeah, and I think that that might be a good segue into the next question. So if you're past the retirement age, so 65 up, and you have investments in a self-directed IRA, can you still make investments from your SD IRA and receive those deposits or profits into it from your investments tax-free? And I would say that that probably depends on the account type, but I think this question might be more specifically geared towards like whether or not you have a traditional IRA or a Roth IRA and those different types of eligibility requirements that may come into play once you're past retirement age.
Right. Well, you can still continue to invest at 65, and you can do so up until the age of required minimum distribution. But you have to take the distribution of assets if it's a traditional IRA at that point.
Yeah.
So, but
And
yes, at 65, you can do that.
Yeah, and then I think the one thing to note, and Scott, I don't know if you wanted to get into this or if you want me to, but we do get a lot of questions often about RMDs with respect to real estate investments. So maybe you want to touch on that.
Well, just, I mean, quickly, if there's other assets that are held, meaning if you have other retirement money that's liquid, and you're, you know, and you're at the point where there's required minimum distribution, we're not fiduciaries, but your accountant would probably say use the cash wherever the liquid money is. Use that. If it's not liquid, then they have to do a valuation of what you are holding to get that distribution satisfied. So we would always say the better bet, if possible, is if you have liquid assets, use that to meet your required minimum distribution.
Okay, thank you. And I do want to make one more distinction as a follow-up from the previous question. So I think that there may be some confusion. So this individual, the audience member, said an SD IRA rather than a traditional IRA. So Scott, can you maybe get into some of those distinctions or the myths about the terminology around what a self-directed IRA is? Because I think some people are sometimes misinformed that a self-directed IRA is an account type and that a traditional IRA can't be self-directed.
Sure. Yeah, and it's common that we talk about it because there's the term self-directed put in front of it, they think it's different. It's the same vehicle. So an IRA, a Roth IRA could be self-directed, a traditional IRA can be self-directed. So when someone says, can my self-directed IRA be converted to a traditional IRA? Your self-directed IRA may already be a traditional IRA. And we could help determine, or working with your financial advisor, they can help determine which one it is. A self-directed IRA is no different than an IRA. So it's just important to understand that so people don't get confused, because I don't want to just throw out self-directed as a marketing term. That's not fair to say either. But self-directing is sort of a process that allows you to invest in alternative assets. And that's what we specialize in. So we'd be happy to educate you on that.
Cool. Thank you. I think that's all we have for today. So we'll jump into some quick, actually, there we go. We got one new message. Okay. Okay.
I think I see from Amy, I would be happy to talk offline with you.
Yeah, I think that's most appropriate.
Like because I just addressed it before. If I wasn't clear, I apologize. But if it's a traditional IRA and you're self-directing with it, it's still a traditional IRA. And if you're using a Roth IRA and you're self-directing with it, it's still a Roth IRA. Self-directing, again, allows you to just use a custodian like Next Generation to help you with your investments.
Yes, I think the distinction that can be made here is that a traditional IRA at a brokerage, like we had explained earlier in the presentation, like if you're at a Fidelity or a Charles Schwab and you're investing in stocks and bonds, mutual funds, those types of custodians or financial institutions don't have the ability to hold alternative investments. That's why when you're going to a firm like ours, Next Generation, we are considered a directed custodian. So the self-directed portion is allowing you to invest in those and allowing us to hold those types of alternative investments. So the account type is never different. You can still have a traditional IRA at, a Fidelity or a Charles Schwab, whatever it may be, at a brokerage, and also have a self-directed traditional IRA at a firm like ours. So that's probably the easiest way to think about it. But let's get to one last question before we get into polling. When profits from cash flow are realized in a SDIRA, do you see investors redirecting those proceeds into stocks until they have enough to meet the next real estate minimum?
If that's for me, I would be happy to, again, there's a lot going on there in terms of when the money goes back into the IRA. So if your investment is complete, if you're asking, can I then invest in stocks and bonds? You can, yes, but you can't if you're holding a self-directed IRA with Next Generation. We would then work with you in moving it to a wirehouse that is more likely like Fidelity or Schwab that invests in the traditional assets.
Correct. Okay, so let's get into some polling and then we'll wrap things up. This is obviously for us just to get to know you guys better. So feel free to answer, but you're obviously not obligated. So the first question that we have is, do you have any existing retirement or savings accounts, and what are they? So going to launch those off. You may have a traditional IRA or a Roth IRA, an employer plan like a 401k or 403b, a SEP plan, maybe a simple plan if you're a business owner, or a solo 401k if you're a business owner. Or there's other types of savings accounts like a health savings account or an education savings account, which by the way can still be self-directed. So we'll just let those answers roll in. Give everyone a few more seconds. Okay. I'll roll that out and we'll share these results. So it looks like the majority of our audience has a traditional IRA or a Roth IRA or an employer plan, which is a lot of the times what we see. So thank you guys for sharing that info. And then we'll move on to the next one. Our next poll is, again, regarding your retirement account. So if you're comfortable with sharing this information, obviously no one else in the audience is going to know that you personally answered this. This is really just for our knowledge internally. But just to kind of get a better idea on the status of your retirement accounts, what is the balance? So we'll launch that one out now. Okay. A few more seconds. Right. And it looks like we have equally 50 to 100K, 100K to 250K, and 1 million plus. That's definitely very healthy retirement accounts. Thank you guys for sharing. And then the last question that we have, obviously, I know you guys are here today to learn about multifamily, which is an investment that you can include within a self-directed IRA, but we were interested in knowing if there are any other types, or if it is just real estate, other types of investments that you may be interested in. So like we said earlier, that can include private equity, cryptocurrency, money lending, precious metals, impact investments, things like that. So if there's anything else maybe outside of real estate that you may be interested in, we definitely like to learn more. Again, we'll give a few seconds. And then we'll wrap this one up and share those results. So it looks like the majority are interested in real estate, which is obviously what brings you here today. Private equity, crypto, money lending, precious metals, impact ESG. It's definitely a good mix. Thank you guys for sharing. We really appreciate it. So with that, we'll conclude today's presentation. We run our webinars monthly, so feel free to come back and register for the next one. We'd love to see you. Before we wrap up, I just wanted to make sure that we get our speakers' info into the chat box. I know Ferris, you had pasted yours up there a little while ago. So we have Ferris at disruptequity.com. The website's www.disruptequity.com. And then of course, Scott's, if you want to just paste yours into the chat really quick so that the audience can have it. Obviously our website, www.nextgenerationtrust.com. You can give us a call, you can text us. All of those phone numbers are available on the website. And then Scott specifically, if you want to reach out to him, he can be reached at scottar@nextgenerationtrust.com. So that info is pasted into the chat box. And with that, we'll conclude today's session. So thank you everybody for joining. Ferris, it was a pleasure having you. You obviously gave the audience some really great information, Scott as well. So we hope to do this again.
One more thing, Erica, if you want to mention the happy hour.
Oh, yes. So in a couple of weeks, we'll be hosting our second networking session of the year. So we're running these monthly on every second Wednesday of the month. Each session has its own theme. So we're either going to do them in the morning, afternoon, or, in the early evening. The morning sessions are going to be Caffeinate and Connect. Our afternoon sessions are going to be a lunch club, and then our early evening sessions are going to be happy hours. So the one coming up in February, on February 9th, is going to be a happy hour at 4 p.m. And you can find the registration to that on our website. But to stay up to date on any events that we have upcoming, you can subscribe to our newsletter. I will paste the newsletter link in just a moment. But definitely, if you're interested, there's going to be a definitely healthy mix of people that attend. So other SDIR investors, investment sponsors, financial professionals, things like that. We definitely like to keep a good mix so that everyone can find who it is that they'd like to get connected to. But like I said, the best way for you guys to stay up to date is to sign up for that newsletter, which you can do through the website, but just generally, I'm going to paste a link to the chat so you guys can get that going. Obviously sign up there, and then you'll get our monthly newsletter, which, covers all of our latest, latest news, latest updates, all of our blog posts, all of our events. All of our on-demand webinars are also on our website if you want to check anything else out. But hopefully we'll see you there. So that brings us to almost exactly 2 o'clock. So we made good timing today.
Perfect.
But again, Ferris, thank you so much for joining. Scott, thank you again. You guys are awesome, and we'll see you on the next one.
Likewise. Thank you guys very much.
Thank you, Ferris. Thank you, Erica.
Bye.
Now.